Welcome to the Deep Dive. Today, we're going to zero in on Trent Limited. You know, the folks behind Westside, Zudio, and Star Bazaar.
That's right.
We've got a stack of recent analyst reports you sent over from Antique, Axis Securities, Centrum, Kotak.
Yep, quite a mix.
They're all looking at Trent's Q4 results ending March 2025 and the full year, too.
Yeah.
So our mission really is to pull out the key stuff from these reports for you.
Exactly. Give you a clear picture of Trent's performance, what's driving it, without getting lost in, all the details.
And see what the analysts are thinking about the future.
And what's interesting is the range of views. We've got buy ratings, an add, even a reduce.
Yeah, so not just one single opinion, which is good. Gives us a balanced perspective, hopefully.
Precisely. We'll look at revenue, margins, store openings, all that good stuff.
Okay, let's kick things off with revenue. The top line. Seems like the big story there is growth, right?
Oh, absolutely. Big growth. Standalone revenue in Q4 jumped about 29% year over year.
29%. Wow.
Oh. Yeah, landing somewhere between, 41 and 42 billion rupees, roughly, depending on the report you look at.
And for a full year, FY25.
Even bigger jump, around 40% year over year.
Yeah.
So total revenue hitting maybe 167 to 171 billion. It's a substantial increase.
That really shows the momentum they have. But what about the existing stores? Like-for-like growth, LFL.
Right, LFL. So for fashion, Westside, and Zudio, that did slow down a bit in Q4, mid-single digits.
Okay, down from high single digits the quarter before.
Exactly. But, Antique points out, and it's a fair point, that's still considered pretty good outperformance in the current market.
Still decent, yeah.
And Axis notes the full-year LFL was actually double digits. So overall, still strong.
So maybe a slight cooling in Q4 for the established stores, but the year overall was solid. How did Star Bazaar fare on revenue?
Star Bazaar also grew 17% year-over-year revenue in Q4.
Okay.
But their LFL growth was, much lower, around 2%.
So Star's growth is mainly coming from new stores opening, not necessarily more sales per existing store.
Seems that way, yeah. Primarily driven by expansion rather than, a big surge in the established spots.
And Antique put that 5-year growth rate out there, the CAGR.
They did, yeah. A 5-year compound annual growth rate of 42% for revenue. That's pretty robust. Really paints a picture.
Consistent, strong expansion. But Kotak had a slightly different take on Q4 revenue, didn't they?
They did. Kotak actually felt Q4 revenue missed their own expectations.
Why was that?
Mainly because that same-store sales growth, the LFL, was lower than they'd anticipated. They sort of suggest things might be normalizing after a few quarters of really high growth.
Right, maybe those super high LFL rates weren't sustainable forever. Interesting point. Okay, so that's the top line. Let's talk profitability. Margins, what's happening there?
Okay, margins. This is where it gets quite interesting, actually. The EBITDA margin in Q4 was a positive surprise.
Oh, really?
Yeah, Antique, Axis, Kotak all noted it expanded by about 101 to 130 basis points year over year.
So just over percentage point improvement.
Exactly, landing around 15.5% to 16%, and that was better than some analysts were expecting.
That's good news, especially with that LFL growth moderating a bit. But hang on, I saw the gross margin actually went down. How does that work?
Good catch. That's the key tension here. Yes, while EBITDA margin improved, the gross margin, basically revenue minus the direct cost of goods sold, it did contract.
By how much?
Fell by about 240 to 266 basis points. So landed somewhere around 41.7% to 42.6%.
Okay, so why the squeeze on gross margin? What are the theories?
Well, a few ideas floating around. Antique wonders if it was more discount sales. Centrum suggests maybe a less favorable product mix or higher raw material costs. And Kotak brings up the Zudio factor, maybe a higher mix of Zudio sales, which could have different margins, or possibly more sales through franchise stores. So essentially, the cost of the stuff they sold went up relative to the price.
Right, cost of goods ticked up. So how did they manage to boost the overall EBITDA profitability if the gross margin was under pressure?
It really seems to come down to controlling operating costs, really well.
Okay. Antique highlights that even with all the new stores, things like staff costs and rent increases were pretty contained. Staff costs up only 3% year on year, rent up 7%.
Despite adding hundreds of stores. That's impressive.
It is. And other operating expenses also grew slower than expected. So it looks like tight cost management was the key lever they pulled.
Smart. Leveraging efficiency to offset that gross margin squeeze. Maybe accepting lower margins per item to drive volume and keep overheads tight.
That seems to be the strategy, yeah. And you mentioned the pre-end as EBIT margin. Antique and Kotak noted that improved too.
Why is that one important?
Well, it strips out some of the accounting noise around leases, giving maybe a clearer view of core operational profitability for some analysts. And that went up from 8.3% to 9.3% year over year in Q4.
So the underlying business operations got more profitable.
That's the read, yes. And for the full year, Antique mentioned gross margins for Westside and Zudio were stable overall, and Star Bazaar saw improvements too. Okay, so a bit complex on profits gross margin down, but overall operating profit up thanks to cost control.
Got it.
Now, store expansion. This seems huge for Trent, especially Zudio.
Huge is the word. They've been expanding like crazy. Zudio is definitely the spearhead.
How many did they add?
In Q4 alone, a net of 130 new Zudio stores.
Just in 3 months.
Yep. And for the full fiscal year, net addition of 220 Zudio stores.
Wow.
Bringing the total Zudio count to 765. That's like 40% year-over-year growth. Antique and Axis both flag that.
And Westside, still growing too.
Yep, Westside added stores too,
Yeah.
just not at that Zudio pace. Net 10 in Q4 is 16 for the full year, so they reached 248 stores, about 7% growth.
Those are big numbers, and I think I saw something about store sizes increasing too.
You did. Antique pointed out that the total retail space grew significantly, 58% for Zudio, 20% for Westside in FY25.
58% space growth for Zudio.
Yeah, and the average store size for both formats also went up by around 12–13%. So not just more stores, but bigger ones too.
Makes sense. More space, wider range, better experience maybe. But Centrum had a slight worry about this Zudio pace, right?
They did, yeah. Centrum raised a point. If that LFL growth we talked about keeps moderating, maybe this super fast Zudio expansion gets put on hold. Their concern is that adding so many stores when sales per existing store growth is slowing could, create an overhang, pressure profitability, maybe the stock price. It's that classic growth versus unit profitability balance.
Right. Driving revenue through expansion is great, but you need the existing stores to keep pace eventually. Okay, beyond the big numbers finances, stores, any other interesting highlights from the reports?
Yeah, quite a few actually. One thing is their push into other categories seems to be working.
Like beauty and home stuff.
Exactly. Beauty, personal care, innerwear, home. Antique and Kotak say these now make up over 20% of standalone revenue. Strong growth there.
And Zudio launched its own beauty line too.
Axis mentioned that, yeah. Zudio Beauty. So they're clearly serious about that space.
Makes sense to broaden the appeal. What about their own brands? Still central.
Oh, absolutely core to their strategy. Own brands were, 72% of revenue in Q4, according to Antique? That's up from 69% the year before?
72%.
Yeah. And for Star Bazaar, Axis and Centrum said private labels are now over 70% of their revenue, too. Gives them control, differentiation.
And online. How's the digital side doing?
Westside's online revenue grew strongly 43% in FY25, says Antique. It's now over 6% of Westside's total revenue.
Okay, so still a smaller piece, but growing fast.
Definitely moving in the right direction. Another big thing is geographical reach.
Expanding into smaller towns.
Yeah, they entered 64 new cities and towns in FY25, a lot of Tier 2, Tier 3 places, now in 242 cities total.
Tapping into new markets.
Exactly. And operationally, Antique mentioned they rolled out RFID tracking for fashion merchandise. Management thinks that's really boosted supply chain efficiency.
Smart tech.
And just sheer volume, Antique and Axis both noted over 40% year-over-year volume growth in FY25. So selling a lot more stuff.
Wow. Okay, what about Star Bazaar again? The food side? What's the thinking there long term?
Management seems pretty bullish on Star's potential. They see it as a big growth opportunity, but they also, acknowledge the competition is fierce. Everyone mentioned that.
It's a tough market. Food retail.
For sure. The plan, according to Axis and Centrum, is basically to use the fashion playbook heavy focus on own private label brands, sourcing locally.
Interesting. Any other diversification moves?
Yeah, two interesting ones. Axis pointed out Trent's getting into lab-grown diamond jewelry.
Really?
Yeah, fast-growing segment. And they've also expanded geographically into the UAE.
Okay, definitely keeping busy. Right, let's bring it back to the analysts. We touched on the ratings, but what's the overall vibe? The price targets.
Okay, so Antique is sticking with a BUY. They nudged their target price slightly to INR 6,646. They expect strong growth to continue sales, EBITDA, profit through FY27.
Okay, bullish.
Axis Securities also keeps their BUY rating, target price INR 6,650. They see about 24% upside potential. They like the expansion, the product refreshes, and see the Star Bazaar turnaround as a key potential catalyst.
Sounds pretty positive from them, too. What about Centrum's ADD? That's a bit more cautious.
Yeah, ADD is kind of like a cautious buy.
Yeah,
Centrum's target is unchanged at INR 6,245. They like the growth story, but they flag the valuation thinks the stock's a bit pricey, and that potential risk around Zudio expansion slowing down if LFL doesn't pick up.
right, the valuation concern. And Kotak is the most cautious with Reducy. Why?
Kotak's main issue is valuation. They have a reduced rating, revised fair value down to INR 5,250. They think it's just too expensive, even with the good margin performance.
So valuation is the sticking point.
Pretty much. And because of that, they've actually trimmed their forecasts for revenue and earnings for the next couple of years. They assume lower sales per square foot going forward. They also noted that capital expenditure, CapEx, is up significantly, even though more stores might be franchise-owned. They worry this could mean less free cash flow generation.
Okay, so a real split then. Growth story versus valuation and future efficiency concerns. What specific risks did they call out?
Across the board, a few common themes. Increased competition access, and Centrum mentioned that.
Always a factor in retail.
Definitely. Also, the risk of just a general weakening in consumer demand. That's a worry for Axis and Centrum, too.
Makes sense.
Kotak specifically highlighted the risk of that LFL, same-store sales growth, staying lower than hoped, and also the risk of that higher CapEx continuing. Important things for you, the listener, to keep in mind.
Absolutely. Okay, let's try and wrap this up. If you had to boil it down, what are the main takeaways from this deep dive into Trent?
Okay, key takeaways. 1, strong overall revenue growth, no doubt, mainly driven by that really aggressive store expansion, especially Zudio.
Yeah.
2, like-for-like growth in fashion stores did moderate, but profitability surprised positively in Q4 thanks to some really good cost control.
Got it.
3, analyst views are split. You've got the bulls focusing on the growth runway, expansion, brand strength. Then you've got the more cautious voices worried about high valuation, potential slowing SSSG, and rising CapEx.
So it really highlights the complexity, doesn't it? Even with strong growth, there are these other factors and risks to weigh.
Exactly. It's rarely simple. This should give you a much clearer sense of Trent's recent journey and the different ways analysts are looking at its future.
Okay, so a final thought for you, our listener, to chew on.
Yeah, something to think about. Considering Trent's big push into smaller cities, Tier 2, Tier 3, and their heavy reliance on own brands, how might that strategy play out long-term? Especially competing against not just other big chains, but also all the local, unorganized retailers.
Good question. What's the competitive edge there, and is it sustainable?
Right. And also, what are the longer-term consequences of this high CapEx and the potential shift towards more franchise stores? How does that impact their finances, their control, their brand consistency down the line?
Lots to consider beyond just the quarterly numbers. Really interesting stuff.